At this moment, let me introduce our next speaker, Marina Shestakova, CFA. She represents one of the oldest private banking family office business in Russia. It is has German origins, operates in Russia since 1999. And Marina is head risk officer at this institution. She used to be involved quite extensively in private equity, and I give the floor to the next speaker.
Yeah, good evening, everybody. As you can see, I have this CFA charter and also Kaya, that's for alternative investments, actually. And I work in the asset management since 2004. And originally I was focused on listed investments and worked in hedge fund and was deputy CIO, chief investment officer. At Vermont Asset Management, we started actually at the institutional level, first private equity investments back in 2006. And I was involved at that time at the level of investment committee as deputy CIO. At that time, we launched a couple of funds with some, I would say, hybrid structure. So partially allocation was to listed assets and partially to private equity and real estate. And since then, we still have, I would say, a couple of investments that we are realizing at the moment. And the only private equity fund we advise is called Green Gateway Fund at the moment. I will tell you a little bit later about some sustainable, I would say, investment, impact investing. And it's invest not in Russia, it's invest in European company, but we can bring some of these companies and good technologies to Russia as well. So let's move on. And my first slide is about allocation of global assets under management. And it's data from 2012 and analysis of BCG, Boston Consulting Group. And in total, they say there are some 62 trillion of assets allocated among different investment classes. And I would say a big chunk of that, about half, is still in traditional assets. So it's like active equity, active bonds, this sort of things. And to alternative assets altogether, it's around 6 trillion, and about half of that goes to private equity. And among alternative, it's like private equity, real estate, infrastructure, commodity, and hedge funds. So it's still kind of not that big, I would say, allocation, and has good potential to grow in the future. So let's move on, and next I will tell you a little bit about European picture, what we can see in Europe. All data is from European Venture Capital Association. And you can see investment, divestments, and fundraise, and that's all for Europe. And so, of course, the peak was before the crisis, so in 2006, 7, and 8, we see a lot of funds raised. And then there was a gap in 2009, and now, basically in 2013, we see some recovery of the market. And next slide, it's hard, I think, to see some data, but it says how much of GDP of different countries goes to private equity investment. Or not goes, actually, what's like size of private equity investments compared to GDP. And we can see that in UK, it's relatively high figure, close to 1% of GDP. And in other countries, it's really small. They do not actually have Russia on this landscape, but I guess it will be somewhere, I don't know, at the level of Ukraine maybe, or Hungary, something like that. And the next slide, we can see allocation by sectors, and yeah, some private equity funds have some specific sector focus, others do not. It's broadly allocated between different sectors in general. Then my next slide was actually about the fund structure, but Oleg already described it more or less. So, there is usually a general partner and limited partners, and the fund itself called some partnership. And funds mainly are based offshore, and general manager can also be based offshore. And in our structure, for example, we also have investment advisor who is based onshore, and it gives investment advice. And we have all different sorts of councils and committees, actually to kind of have best corporate governance as well. And if we move on to some type structures, basically the term, usually it's like 10 years, and some extension is possible. And then when you look at some term sheet of the fund, so what you see, target fund size, the closing date, and some targets on return, and some data on something on like management fee, and on carried interest. Carried interest is basically how much of profit goes to the team, to the general partner. And there can be some particular features like preferred returns, some downside protection, and so on. And funds can be focused on some sector or on some region, or has more general type. Then this slide is example of our fund, Green Gateway Fund that we have. So it's like typically like the process working. So you have a lot of companies the team looks at, and then just part of it, maybe some 20% are considered to be qualified projects, and much less goes to the level of investment committee. And for example, the team now looked at more than 200 companies and completed 4 investments so far. Here on this slide, I have different types of private equity funds described. So that's... can you see something, by the way? Not really, what would you think are the biggest type of funds? Buyouts on global scale are the biggest one. We have data from global data. It's from Preqin. It's like biggest database for private equity. So most funds report to it. Basically, there are different types of private equity funds, venture capital, and it's also, there are some subgroups like seed, startup, and later stage venture. Then there are some growth funds. In growth funds, it's usually minority stakes and where the business is planning to expand. And then we have these buyout funds. So when usually the whole company is acquired, and leverage buyouts where leverage is used for the deal. And then there are some rescue, like turnaround stories, and also there is a replacement capital when some stakes are bought from other private equity funds. On investment process, I also probably would not stop for a long time, as Oleg also touched on that. And this one is like how return usually, or what we see in terms of return. So from original investment in first years, we usually see the negative numbers as business is kind of still growing, and there are some fees and investments are not yet revalued in first period. And then if everything goes well, we see the growth. In this slide, I talk about different type of divestment. So how the private equity fund actually can exit from its investment. And on the right, it's also data from European Venture Capital Association. It's recent data, 2013. And if you look at buyout funds that are biggest in size, you can see that some 28 billion out of 33 divestment in total were from venture capital. So we see that trade sale is still like #1 exit, and then sale to another private equity firm is also kind of popular. And IPO, like initial public offering, we do not see that many deals actually that go to IPO stage. And of course, also important divestment type is like total write-off of investment. That also happens, especially in venture funds. It's quite often, I would say. Next, I want to talk about like performance of private equity funds and comparison to performance of stock market and stock market indices. And I have the data till December 2012. So guys, I guess you got a bit bored, so maybe just what's your guess? What would be the average performance of private equity compared to index? How much it outperform or underperform the index per year? Just some guess. 5%? Okay, outperform 5%. Any other proposals? Okay, I guess you are tired today. So let's see. That's also data from Preqin, and it shows the performance basically of all private equity funds. And I guess the guess was not bad. Yeah. So there are some more data on that, and what is interesting is that there is a lot of performance difference between good performing private equity funds and bad performing private equity funds. You do not have it if you kind of invest in some ETF, exchange traded fund that tracks the performance of, I don't know, S&P index. Then you would not have a lot of difference in the performance. And here it really differs a lot. So the bottom line is kind of bottom quartile of private equity funds, and top line is top quartile of private equity funds, and difference in performance is substantial. So if we take like 2002 vintage year is like, it's good to compare the private equity funds by vintage year, when it was launched basically. So if we look at 2004, for example, top quartile returned more than 24% IRR, and bottom one just 6%. And so as the performance is so uneven, there are kind of a number of research on that topic. Either private equity funds outperform stock markets or underperform stock markets. And I would say results of this research are also quite different. So the graph that we saw is with Preqin database. It shows that, yes, on average, private equity funds do outperform stock market. And that's good, at least for those who are in the industry and trying to fundraise. But there are kind of number of other researchers. Some of them say that actually if you kind of adjust this performance for some top performing funds and so on, and take out all fees, commissions, then on average they would underperform the stock markets by the same 3 percentage points per year. And the main question for an investor who invests in private equity fund would be how I would choose the fund that will be in top quartile. As you've seen before, the difference in performance is really substantial. And then what's interesting about that, that's like, according to some research, around 77% of all private equity funds, they claim that they are top quartile funds. And there are different ways how you can kind of, not really cook numbers, how you can present, I would say, your results compared to your peer group. And yeah, and how you calculate numbers as well. So that's not an easy task to choose top quartile fund globally. And also the question is, if like fund number one was successful and was really in top quartile, how likely is it that fund number two will be also successful? And of course, private equity firms, they claim that they can be successful in next funds, but again, if we look to some research, it shows that around a third of private equity funds that were in top quartile became top quartile funds again. And that's of course not that encouraging, but not so bad, because only like 16% of managers who were in bottom quartile moved to top quartile. So yeah, that's about performance of private equity funds. And if I still have some time, yeah? Okay, maybe I will tell you a little bit of like what is our focus of our private equity fund was and what we are doing. So our focus was on impact investing. And impact investing is investments in basically companies that intend to generate some measurable social or environmental impact. And plus, that is on top of also financial return. And there are different kind of areas. It can be social, governance, and environmental impact. And our one is mainly focused on some environmental impact. There are different metrics, and even Bloomberg today, they do for companies with ESG, so-called rating, that is environmental, social, and governance. I would say Russian companies so far are not kind of that active in this area, and you probably would not find one with good rating on Bloomberg, but still. In this fund, we are focused on European companies mainly, and the next slides will tell you why we decided to do something like on environment, to make an environment better. On this slide, you can see the global energy consumption and CO2 emissions and like global real GDP growth. And we see that CO2 emissions globally, they're still rising and they're really high. And this means a lot of CO2 emissions means that global temperature is growing on the Earth, and that's dangerous. And in terms of world CO2 emissions by regions, recently it changed a lot to emerging markets, and you see that China is now kind of on top, in top league of generating these CO2 emissions. However, some rich countries, I have here the example of Germany, they managed to cut CO2 emissions in recent years. And the target, basically in Europe, recent one is to reduce emission by 40% from 1992, I think, level by 2030. Next slide. What is interesting, I would say, it's the collapse of Arctic Ocean summer ice. As I mentioned, the temperature is growing, and what global experts say that if global temperature increased by 2 more degrees, it will be a real problem for global world. And yeah, you can think maybe that it's like, yeah, what is dangerous is ice melting in Arctic and Greenland, but what's also dangerous that we can see more and more extreme events like hurricanes, for example, or what was it, like ice rain, these sort of things. And in recent years, these hurricanes, they became more and more kind of dangerous. That's Arctic summer ice cover, and that's pictures from NASA satellite. And here you can see how it was in 1982 and how it was in 2012. And we can see that it's really melting a lot in summer. And this is the same, more or less, pictures from NASA for Greenland. And it's also melting. It's actually melting a lot. And that's nice photo how you can do your kayaking in Greenland, some 3,000 meter deep cracks. And that's what would happen if we have 2 meter high sea level. So more than 1 billion people will have to look for new house. And here how we can have a look how Russia is standing compared to other countries. And we are, of course, champions in energy consumption and CO2 emissions. In Russia, it's like we have cheap energy compared to Europe and cheap gas. And it's not very kind of not enough motivation to cut energy consumption and cut CO2 emissions. But you can see per GDP, it's like 4 times bigger than in Germany, and a lot of potential to cut. And there are a number of funds. Actually, more and more people are now interested globally in impact investing. And there are the whole wealthy families and wealthy funds with some really trillions of assets under management who are looking for impact investing and do not have enough kind of vehicles available to put their money in. And so one can think that it's like philanthropy, so you do some impact but get negative returns. But in reality, there are a number of ideas, projects that can generate both positive income and positive returns. And so you can find some good funds in this area, and this like McKinsey abatement curve, so-called. And if you look at the left bottom corner, it shows that in reality there are some technologies that are already resource efficient and that can make some profits without further government subsidies. And just in Europe, if you implement like all of that stuff, it can save some 3% of GDP today already without further subsidies. Okay, that was, I think, it from my presentation. And if you have any questions, you are welcome.
If there are no...
Good that it was self-explanatory one. Okay, thank you.